We had the first reading of the UK GDP for 2012. This covers the period between January and March of this year, and the hope and indeed expectation was that the UK GDP would indeed show a very modest rise. In fact, the number came in below expectations, and under the technical terms of recession, confirmed a return into a recession for the UK market. And I think it's just useful here to take a look at this first chart, which has analysed many of the recessions that have taken place in the UK, really just to look at the way that the GDP recovered post the recession. And here you can look at the sort of 30s, the 70s, the 80s and the 90s, and they all really followed a fairly typical path of recovery with GDP. The black line here is highlighting the current cycle, and I think that that story indeed tells the tale that the UK economy remains still significantly below the GDP output that was registered at the beginning of this recession. Is beginning to flatline again at the moment, and recognises what is taking place throughout Europe as well, and the struggles that brings to the UK in facilitating some sort of recovery or strengthening recovery out of our market here. So disappointing times for the UK. Today, on Friday, we should also hear that same number regarding the US first quarter GDP. So this podcast is being produced before that number, but the expectation is that the US will have seen a 2.5% growth in its GDP, so a much stronger number from the US today. In fairness, much of the data that's been coming out of the US recently, some of those forward-looking surveys, numbers relating to consumer confidence and other forward-looking surveys have indicated slightly disappointing trends in the US. So it is going to be quite a keenly looked at number for the first quarter. But one thing I will add is that despite disappointing macro data and indeed disappointing issues in Europe, financial markets seem to be absorbing this bad data reasonably well. Indeed, the S&P and the Dow Jones Index are not far from their sort of year-to-date highs at the moment. So, as I say, the negative tone is not necessarily weighing on stocks at the moment. And partially the reason for that continues to be the good corporate earnings flow. Highlighting a couple of US companies here that have been in the news this week. Apple reporting its first quarter numbers, and despite the valuation that's been moving ahead significantly this year, you can see this sort of sharp spike showing that earnings for Apple were about 30% ahead of expectations for the course of the first quarter. And indeed another company that reported in the US where we saw shares trading about 15% higher in aftermarket trade was Amazon. Amazon reporting 35% growth in first quarter sales, so similar to the fourth quarter of last year. So no indication from Amazon that they are seeing a slowdown in sales growth, and indeed the key really to Amazon's valuation is going to be how they begin to convert some of their gross profit margin into bottom line profits, and that is going to be the key question for the valuation going forward. But nevertheless, you can see that stocks are responding positively to earnings. I just want to look at some of the UK companies that have been in the news this week, starting with AstraZeneca. Now, the pharmaceutical companies, both AstraZeneca and Glaxo, and indeed Shire Pharmaceuticals, have all been reporting this week. And I think it's fair to say that the news out of the healthcare sector have been slightly disappointing. AstraZeneca downgrading some of their EPS expectations for the full year. Now, what really seems to be the case here is that sales on the top line have been quite sharply lower than expected. They do have a little bit of a cliff of patents coming offline shortly, and some sales declines coming through. They've been managing the cost base well, so the bottom line profit is not as bad as the top line would suggest. But it has meant that the chief executive of AstraZeneca has announced his retirement from June, and there is a feeling that somebody new needs to come into this business to give it a new head of steam. So as I say, disappointing there from AstraZeneca. Glaxo Glaxo, in fairness, hasn't been too bad. The numbers this week were pretty much in line with expectations. It's been flatlining a little bit. It's a defensive stock, but no cause for concern with Glaxo in its share price at the moment. Whitbread I wanted to highlight because it is a consumer-facing stock. It does serve coffee to people. It does put them up overnight in their Premier Inn hotels. Well-run company, and there's always been a question about what the breakup or potential breakup value of Whitbread is, and that share hitting pretty much all-time highs here on the back of these strong numbers. It is fair to say that in the US, Starbucks has a very lofty valuation of $45 billion. It's a company probably broadly about 9-10 times bigger than Costa Coffee in terms of its comparative financial performance, but unfortunately Whitbread doesn't get quite the valuation for its Costa Coffee division that Starbucks achieved, but that in itself highlights possibly the sum of the parts valuation in Whitbread, and is continuing to keep that share price moving quite smartly ahead. I'm turning to next week. Just keep an eye on a couple of stocks that are reporting next week. BP has had quite a sharp pullback from £5 to £4.30. Results due out from BP in the course of the Tuesday of next week, and we're also in the midst of the banking season. Barclays this week have reported their numbers, which I felt read quite well. The key numbers that banks tend to look at, things like return on capital employed, were all moving nicely in the right direction, up from 10.2% to 12.2%. So a lot of the headlines around directors' pay, but I think the underlying performance of Barclays felt pretty good. We should be hearing from Lloyds next week, and so we need a stable banking sector, and in fairness the UK banks have been certainly much more stable in terms of share price performance than some of their European counterparts. So that is something to watch out for next week. Just want to finish with one final chart. It is a reflection of the continued woes in Europe at the moment, which will continue to hang over markets. We've had the downgrade in Spain. That naturally is impacting on Spanish yields, and again the stresses between the poor and the strong in Europe is highlighted in this chart here. This is 2-year paper for Germany, and you can see there that yields have now got down to levels of about new lows for 2-year paper, and it's indicative of how much money is heading to the strength of the German economy at the moment and away from some of the weaker players. So the difference between the good and the bad is just continuing to widen.